Next we come to incomplete records. One of those topics that requires considerable amount of skill. Now do be careful of that. It assumes that you're fairly relaxed about things like control accounts, cash books, indeed a few adjustments as well. So incomplete records. This section of the notes has something like 13 examples. Okay, all of them quite small, most of them quite small, but quite deep. The understanding of the relationships of accounting that we've gleaned over all these sessions, we've gained over all these sessions, that's really what's going to be put together here. That's why we do it quite at the end, nearly at the end of the whole syllabus. Requires huge amounts of skill. The examiner is aware of that, so you need to be well prepared. So there are 13 examples that will take us a long time to do. Let me take you through these various points. So we're moving therefore to session number 12. As the name suggests, incomplete records are any form of accounting records other than full double entry system. See? Any form other than. So anything other than full makes it incomplete, obviously. What else can we say? In reality, accountants come across incomplete records almost daily. This is because their clients are not likely to fully understand the double entry system. We still, however, need to prepare a set of financial statements for the client. You see? So the financial statements have to have double entry built into them. And clearly, if the client has only done half of these entries and the records are incomplete, our skill is to come in and work out the rest by deducing different figures, using logic, that kind of thing. And of course, considerable accounting skill. During the exam, students will often come across incomplete records. The main reason is often due to a flood or fire at the exam hall. Sorry, at the business premises. So there's a flood or fire at the business, and some of the accounting records have been destroyed, but using your considerable skill, you can reconstruct what is missing, and get it back to being full records. So for that, you might have to use things like percentages and profits and a tremendous amount of skill, to be honest. So let's say, calculating profit. If a business has very little information about its transactions, it may only be possible to calculate the net profit for the year. This can be done by using the accounting equation, very, very important indeed, and it can be written out as follows. Net assets equals capital plus profit minus drawings. Think about it. The net assets, the assets minus liabilities at the year end, must equal capital plus profit minus drawings. Two sides of the equation, what's known as the accounting equation. Or it can be expressed in another style. Change in net assets equals capital introduced plus profit minus drawings. Change in net assets equals capital introduced plus profit minus drawings. You may realize that this is very simple and indeed very similar to the statement of financial position, so also known as a balance sheet, of course. So let's get busy with a few of these examples. Before I do that, can I just say you must memorize this, or indeed any format that makes sense to you. The other way I could describe it, I suppose, is this little section here, profit minus drawings, is like capital made by you. The capital introduced plus the capital made equals a change in net assets, of course. And the capital made is the profit that you've generated minus what you've taken out to live on, the drawings. Right. Very similar to the SFP, of course. Right. Incomplete records. See, the big fear I have is that it has a tremendous ability, flexibility to be examined as 2-mark questions. Many of these things will be fair for a 3 or 4 minute exercise. So here's the first one, example 1. This is to do with our session 12. There's just the book, the notes say it's session 12. Incomplete records, a great topic requiring a bit of skill, of course, and the ability to use logic, grounded on accounting skills, of course. Right, let's go. Example 1, a sole trader's statement of financial position at 31st of December 2006 shows that the business has net assets of 5,000. The statement of financial position at 31st December 2007, so shall we say 2006 is the opening? So near the word 2006 you can write opening, near 2007 you can write closing, shows that the business has net assets of 8,000. The owner's drawings for the year amounted to 2,500 and he didn't introduce any capital during the year. In the year. Calculate the profit for the year ended December 2007. Obviously you have to work backwards. So let's do precisely that. Calculation of profit for year ended December 2007. So you've got your opening capital shows that net assets, by the way, the opening net assets equals opening capital, of course, is said to be 5,000. So I'm going to drop that into the opening slot. The plus net profit, the unknown quantity, is the figure that's missing over here, which I'll work out in a minute. Keep some space for the running total. The next one, of course, is less drawings. What you've withdrawn to live on during the year is 2,500. So if that's what you've taken away to live off, the last item here is the closing net assets. I saw that as 8,000. So that's the closing net assets. Net assets, of course, equals capital. Equals capital. Now, this is where you have to use logic. Concentrate very hard and use logic. If that's 8 at that stage and 2.5 was taken off, this must be 10.5, working backwards. You get that? So if you're working in this direction, if you have 8,000 at the end but 2.5 taken off, the intermediate figure before it's taken off must be 10.5. And if that's 10.5, the figure that's missing has got to be 5.5, balancing figure. So what I would do is to put my opening net assets in, leave 5 or 6 lines, say 6 lines, and come to your closing net assets. Then drop in all the figures you can, not forgetting that opening plus net profit minus drawings equals closing. Opening plus net profit minus drawings equals closing. And thereby you come to your basic framework. I'm very much in favor of keeping the framework the same and working backwards if necessary, if challenged in the exam. I don't like the method where you change your framework for each question. That might, number one, lead to confusion in the exam, and number two, of course, I think you must have a framework that works in every case, and the more familiar you are with the framework by using and reusing the same framework, the more assured your answer will be. So I'm in favor of saying opening plus net profit minus the drawings equals closing, and then every question can be slotted into that one framework. Please consider that technique. So we're working backwards, basically. That's my example 1. Let's move on to example 2. Don't worry too much about the description on the next page. Mostly irrelevant. So let me take you back to the notes. So we've survived example 1, done that, that's good. Let's move on to example 2, 3, 4. There are 13 of these, so we'll take a bit of time. But each one brings out a special meaning. So don't worry about that particular layout. Any layout is fine, but the one I've shown you probably is the best. As you can see, it is impossible to know the makeup of the net profit due to lack of information. It's true. Preparing financial statements from incomplete records. In the majority of cases, a small business will keep limited amounts of records. It's true. The business is much more involved in, making the profit, running the business. So the keeping of records doesn't seem to be very important. But nowadays, of course, you will have staff and there are rules to follow and perhaps computers help. But here we are. In these types of questions, you will be given information regarding the opening and closing balances of assets and liabilities of the business. You will also be given information about certain transactions during the period. This is usually a summary of the cash book, that kind of thing. Okay, so be careful. There are two main techniques used in incomplete records. So two main techniques. One is the balancing figures type of technique in ledger accounts. And the other is, so balancing figures is the first technique that you need to master. The other, of course, is you might have to use ratios for markups based on cost or margins based on selling prices, that kind of thing. So traditionally, markup means based on cost, margin means based on selling prices. So balancing figures, the balancing figure approach is commonly used in the following way. If you have a ledger account, the missing figure could be sales or money receivable from accounts receivable. So that's usually the first bit. Accounts payable, you could have things like purchases, money paid to accounts payable suppliers. So receivable, of course, is customers. Payable, of course, is suppliers. So these two could be balancing figures. Cash at bank could be drawings or indeed money stolen by a member of staff or something like that, or a break-in, burglary, something dreadful like that. And then you have cash sales and cash stolen. So let's move on the next page to example 2. So this is example 2. Suppose that the opening balance on the accounts receivable ledger was 50,000. There had been receipts from account receivables in the year of 45,000. Irrecoverable debts have been written off worth 5,000 and the closing balance was 55,000. What were the credit sales for the year? Don't look at the account just yet, the answer. I'd like very much to set up something on the screen, as we would have to do in the exam, of course, writing on a blank sheet of paper. We have plenty of paper. The ACC are very generous. If you are doing the computer-based exams, you can use as much paper as you like. So let's have a look at example 2. What were the credit sales for the year? So I'm going to go for something like the accounts receivable account itself. So I'll say accounts receivables account, debit credit. Obviously, the receivables is an asset, so I expect it to be a debit. So the opening balance is said to be 50,000. What can I do except put it on the debit side? So these are all dollars. Very easy indeed. So I'll say opening balance brought down 50,000. Tick it off on your question paper. Then the receipts from accounts receivable in the year of 45,000. So that should be on this side, because obviously we are debiting cash and crediting this account. So I'm going to say cash or bank receipts for the year, 45,000. Tick that off. Irrecoverable debts have been written off worth 5,000. I suppose they must come onto this side as well. Irrecoverable debts. That account, of course, is debited. This account is credited. That's a double entry. And so if you've been given a closing balance of 55, I'll put it onto this side. Closing balance carried down is given. All I'm going to do is to put everything through a little working mechanism, adding up. Indeed, we've set up the working there. Leave a couple of lines, and just in case something jumps up on us. So I'm going to leave a couple of lines. Just to extend that downwards a bit. If you can see, the credit side is comfortably heavy at 105. Put that 105 on this side. And the difference between the two sides, of course, is 55. And that is the sales, which is nothing but a balancing figure technique, you see. Therefore equals 55,000. And that is the end of the year figure. So the opening and closing balance is all given to you there. So notice the way I did that. I had an opening balance, I had a closing balance. So these figures are given, you see, that's given. This is given, this is given, this is given. And using my control account skills, I put everything I can into this big receivables account. And what's emerging is the sales for the year. So let's go back to the question and see what it says. It says, here are the facts. Can you please use the balancing figure technique that was introduced a few minutes earlier to work out what the credit sales for the year were? So I'm going to say credit sales for the year. So this is my answer. Very straightforward indeed. Right, it's time to march on to the next exercise as we keep fighting our way through these various examples. Try again not to look at the solution as we consider these various questions. So blot out the solution as we concentrate on the example. Says question, suppose that the opening accounts receivable balance was 30,000. There have been total receipts from customers of 55, of which 15 related to cash sales and 40 related to receipts from accounts receivable. So obviously the 40 plus the 15 together come to 55. That makes sense. Discounts allowed in the year totaled 3,000. And the closing balance was 37,000. What are the total sales for the year? You can approach this question, by the way, in two different ways. We can calculate the credit sales as above and then add on the cash sales, or we can use ledger accounts to calculate the total sales. Both methods are shown. So I'm going to pretend as if this is all the question shows me. Below that, it isn't available in the exam. you've got to make up that part of it. So that's why I would like very much for you to break back to the workings page where we're doing all this. See whether we can write on a blank sheet of paper more or less to see whether these various exercises make sense. Here we are. Example 3, therefore, within our grasp. Calculation of total sales for the year. Calculation of total sales for the year. So different ways you can do this. One is to prepare what's known as the total sales account where everything comes in, or to do it in 2 steps. Entirely up to you. Let me try this T account for total sales. I'm afraid where you've got incomplete records, this T accounting approach does help a little bit. The only time where you can be a little bit free of that is when you're doing cash flows. But otherwise, for most topics, I would say, for this level of exam, T accounts is best. Right, let's go for it. You can either say total sales account, in which case you've got your total sales figure as a balancing figure. So you're answering the question exactly as it's set. So there you are. Those are your debits, or will be in a few minutes. Over here we have our credits, and we just bring in all the information we can find. The opening accounts receivable is 30,000, so I'm going to say on this side, because it's a debit, accounts receivable is a debit, so opening brought down is 30,000. There have been total receipts from customers of 55,000. So I suppose I'm going to debit cash and credit this. Cash bank account was debited and this is credited, 55,000. Don't forget that 55,000 has got 2 branches to it, 15 and therefore 40 for cash and credit type sales. If you want to analyze it. That's the second item under control. Discounts allowed is said to be 3,000, so I'm going to put that on this side. Discount allowed, of course, is an expense to us, so we're going to debit our expense account, which ends up in the income statement. So debit discount allowed account, and credit this one. 3,000. The closing balance is then given as 37, so it must appear on this side, the opposite of the opening, of course. And the reason why you put it on that side is when you add it all up, you can then bring down the balance into the new year on the equivalent side as the opening went into. So I leave a couple of lines just in case, and then rule it off neatly. We should be okay. So the credit side appears to be about 95,000. This is 95,000. And so the difference between the two, which is presumably 65,000, is the answer, you see. So that becomes the total sales. And of course, if it's on the debit side here, The credit will go to the income statement, the balancing figure, total sales for the year. For the year, let's not forget to say that. And obviously that will enable you to do your income statement, your final accounts, etc. So quite an easy exercise, as you can see. Another way of doing it, I understand, some people like this, I prefer the method I've just shown you, is where you only do the accounts receivable, the credit sales only, and then show the other items separately. Just to distinguish the two, what I might do is take you back to the original notes and show you how all this works. So let's say I would recommend you doing the one we've just done. Otherwise, you can come here to the accounts receivable, account, get rid of all that, debit, credit. So you can see there the brought down is 30, the carry down is 37, the credit receipts and the, just the credit receipts, not cash. Not cash sales, not for cash sales. So that's 40, and so the answer, of course, emerges as 50,000, and you just top up the cash sales to give you 65. So I can't see why people would do that when there's a much easier method available. What people are doing here is sticking to the principle in control accounts that you can only bring in credit sale items. But what I'd like you to do personally, from me to you, is to adapt the control account technique, which is meant to be only credit sales and credit purchases, adapt that to call it total sales or total purchases, in which case you have your cash in there as well. You're just playing around with words. If you call it total sales account, it gives you the total sales for the year, which you then transfer to your income statement. I would personally prefer the total sales type of terminology. But I'll leave that to you. Right, let's march on to example 4 as we continue to do business with this quite detailed syllabus and indeed this very detailed session. Right, example 4, the opening balance on the accounts payable ledger. I see, now we're talking payables, be careful, suppliers, that kind of thing. The opening balance of the accounts payable ledger was 30,000. Payments made to account payables during the year were 33,000. Discounts received were 4,000 and the closing balance was 26,000. So here we have the payables control account, if you want to call it that, or you can call it total purchases. Just for variety, I'll take you through the ready-made answer, since we are well into the swing of this by now. The opening balance is 30,000, so that should be on this side. You can write credit there, debit here. So that's all right. That takes care of this one. So the opening balance is on the credit side on the grounds that this payables control is a liability, because obviously liabilities amounts you owe, and of course liabilities are credits. So the opening balance must be a credit item. So that's the opening. This one is the closing. Let's see if we can do this. Payments made to account payables during the year were 33,000. The purchases, in fact, that's not quite the right figure. They look a bit strange. This one is the 33 I should have ticked. 33,000 is the payments, so that goes to bank account. Think of the double entry. If you debit payables, which is what this is, you need to credit bank because you've paid the money out of the bank account. So bank account credit, this account debit, that's how your 33 is fixed up. The discount received, of course, is 4,000, and so the figure that turns up as the balancing figure is purchases. The lovely feel to this, of course, is apart from it being a balancing figure, and if you've done your sums right, you probably are right there, get your full marks. The interesting thing, of course, is if you credit your payables control account as we're doing here, if you credit your payables control account, just as we did just now, the debit, of course, will go where? You're right, it goes to income statement as purchases. That's a way of getting your answer quite quickly. So it's a debit to the income statement and a credit to this account, and that's how your figures are arrived at. Very, very straightforward. If you consider the discount received on the debit side, this account is debited, the payment control account is debited, and obviously the discount received account is credited, as indeed it should be, because discount received is income, and income items are credits. So that's the way the logic flows. And so we move along nicely, steadily through the question. What else do we have? In example 5, so looking at the solution then to example number 5, here is the solution. The total purchases account or accounts payable, whatever style you want to use. These are suppliers. These are also known as creditors, that kind of thing. So you've got your debit on that side, you've got your credit on this side. The opening brought down, the opening is said to be 15, so that's in place. The closing was 11, so that's in place. 11,000. What else? The total payments made to suppliers was 14,000. So I presume that's a credit to bank and a debit to this account, so that's fine. Discounts received were 500. So debit this account, credit discounts received. And of course, the closing balance is given. So the figure that is derived from all of this is therefore purchases. As usual, a lovely little feel to that. This is just a little practice question based on what we did before. It's very interesting because if you credit your accounts payable as here, you can actually debit your income statement with the total purchases, which of course this account is trying to be. So I'm slightly adapting the titles to these accounts. My success on this question is based on some skills on control accounts. That's really what I would like you to develop. So if you have problems with this, it probably means you have problems with the control account. So go back and have a look at that particular session, stop the tape, revise all that, because it is coming up in the exam. Obviously incomplete records comes up as well, but that comes up on its own control accounts. So if you master control accounts and then you come along and have a look at this, this topic, incomplete records, becomes so much easier. Now, what else do we have? Here comes a completely different concept, different skill. Very, very important indeed. The ability to do prepayments and accruals. Slightly complex, slightly worrying, so I'm just going to read the question with you and take you slowly through the solution. But for the moment, you must blot out the solution. You mustn't worry about it at all. So I'm going to put all my solution out of your mind. Let's concentrate on the question first. The following information relates to the rent and rates for a business lady called Susan for the year ended 31st of December 2007, whatever. Opening balance rent prepaid is 300. Rates accrued is 500. So prepaid is where she has paid last year, but for this year. So at the end of last year, she has an asset. That should be an opening debit balance. Rates accrued, of course, is what she hasn't paid for last year, presumably because the local authority, the government agency, whatever, whoever charges these rates, they have not asked for the money yet. So, but in her mind, she's set it up as an accrual at the end of last year and will be paid early in the new year when the bill actually arrives. But by accruing last year for rates that should have been paid last year, she has a more true and fair profit figure for last year for her business. So prepayments and accruals, no problem. Cash paid during the year, interesting, is for rent and rates as much as 4,100, massive number. And then you have the closing balance, rents prepaid, rents accrued. You just have to be very, very, very careful as to which side of the account it appears on. So maybe I'll just, given its danger, this particular item and its significance, I shall just do something that I don't always like doing, but just for clarity this time, I'm going to show you everything on the face of our little class notes. Okay, so debit on that side, credit on this side, dollar signs, etc. The question says there's rents prepaid brought down, so that's this item, isn't it? 300. Paid last year but for this year. Imagine if nothing else happened, absolutely no more items appeared, that 300 would be put onto the debit side and the double entry, the reference would be income statement. So it will be put onto the credit side of this, and the debit, of course, will end up in the income statement. So if you start off with a prepaid on the debit side, if you put the 300 onto the credit side, the books will balance, and obviously the double entry for that credit is a debit to the income statement. Very straightforward. Now, the rates accrued are said to be 500 as given in the question. Let's go back, have a look. 300 and 500 nicely in place. Then comes the 4,100, which is presumably a credit to bank and a debit to this, cash paid. The rent prepaid is 350. That goes here. And obviously that comes down like that. So this, we're going to have prepaid brought down of 350 at the start of next year, and this 450 will be an accrued brought down of 450, and so it goes on. So you always put it on the wrong side above the line. Okay, so that's absolutely vital. If that surprised you, you need to go back to one of our first sessions. We came across a question called George and one or two others. I think it's a lady called Tina, which I set for homework. You need to brush up on those, because where you have a closing balance above the line, it's always on the wrong side, so to speak, to enable you to bring it down across the page to the other side to start off your new year. So this is also put on the wrong side. When I say wrong, very much in inverted commas, it's correct to do so, but it's just on the wrong side to enable you to bring it down to the right side below the line. Okay, so a little accounting convention, a bit of a mystery for people who are not accountants, but you must be well into this, having been with me through those questions like George and Tina. So there you are. The figure, therefore, that turns up as a balancing figure goes to the income statement, of course. This goes to the income statement as 4,000. Not 4,100, that's the cash paid. Would you agree the 4,100 partly clears the 500 brought down? The 300 is part of the 4,000, but that was paid last year, you see, prepaid. And similarly, at the end of the year, the 450 should be part of the income statement charge, but because it hasn't been paid, you just set it up on the debit side so that whatever's on the credit side must take into account that extra 450 on the debit side. Similarly, the rent prepaid, even though it's part, the 350 is part of the 4,100, by putting it on the credit side, it eats up some of the 4,100 on the debit side. And so whatever's left goes to the charge for the balancing figure, of course, the income statement. So thereby you've perfected and corrected and purified that figure of 4,000, slightly different to 4,100, of course, because that truly, the 4,000 truly is the income statement charge for the year. When you're ready, I invite you to move on with me to example number 7 as we tackle some other issues here. Example number 7. On the 1st of January, the bank is overdrawn, that is to say, our bank account, by 1367, so that's negative. Payments in the year total 8536, and on the last day of the year, the closing balance was a positive balance of 2227. So what is the total receipts figure for the year? Now this is absolutely straightforward. What we must say is, if the bank is overdrawn, that 1367 should be the opening balance on this side. OD, oh dear, overdrawn, 1367. The payments in the year totaled 8536, so you credit your cash book, of course, because these are credits, these are debits. You credit your cash book and you debit whatever expenses. Expenses are debits, of course. So if you debit expenses and credit cash book, your 8536 should be under control. The closing balance is then given as 2227. No problem. It's a positive balance, interesting. The positive balance is 2227. And so the figure that's missing must be a balancing figure the figure that's missing must be a balancing figure of 12,130. The explanation, I suppose, we started overdrawn 1367, we spent 8536, and we have a closing balance left of 2227. So let's think about that logically. Obviously, accountancy is based on logic. You start with an overdraft of 1,300 and so on. You spent 8,500, etc. So would that mean the overdraft has got even worse? At the end of the year, you've got about 2,200 left. So if you've got an overdraft, you've spent something and you still have money left, how is it that you still have money left? You must have received a huge receipt during the course of the year. Your cash inflow must be huge to finance all of that. You see? Must have received lots during the year. So I'll go through that again. You have an overdraft to start with. You've spent money this year, huge amount, and you have something left as a positive balance. So your overdraft has been converted into a positive balance. So how is it that you had all this good news? You must have received lots, lots and lots. And that, of course, is 12,130. That's the logic behind the scenes. Right, example 8, when you're ready, let's use the same sort of technique. Scott has a cash flow to the beginning of the year of $900. During the year, cash of $10,000 was banked, $1,000 was paid out for drawings and wages. So I'm going to blot out my answer here, making sure you don't see it. If possible, avoid looking at it. Scott has a cash flow, so you're Scott, at the beginning of the year of 900. During the year, cash of 10,000 was banked, 1,000 was paid out for drawings, and wages of 2,000 were paid. Scott decided to increase the flow to 1,000 at the end of the year. So the opening balance was 900, but at the end of the year it was 1,000. So this was 900, now it's 1,000. How much cash was received from customers during the year? When you're ready, I invite you to come back and have a look at the cash account. How much cash was actually received from customers, the question says. how much cash was actually received from customers during the year. Here we have it, a debit and credit, dollars, etc. Cash the cash account, the opening balance was said to be, as you saw earlier, the cash float, as they called it. The little balance on cash was 900. At the end of the year, of course, it was 1,000. And rather like our previous example, how is it that 10,000 was taken out of cash and put into the bank account? So it's a credit to cash account and a debit to bank account. So there are two separate accounts going on here, you see. So the cash flow to petty cash, you've taken out 10,000 and put that into the bank account. So how come you had 10,000 coming out of 900? How is it that you've withdrawn for your personal consumption this year 1,000? How is it that you have wages of 2,000? The difference, of course, is receipts, 13,100. Like before, we must have received lots of cash to do all this activity on the credit side. So that's the logic. We received lots of cash to be able to spend i.e. pay out, etc. All this on the credit side. So if you've got 900 only and you've paid out 10,000, 1,000, 2,000 and you still have a good balance left, it must mean you've received a huge amount, 13,100. Okay? So that is the closing balance. The other one was the opening balance. And so it goes on. Very, very straightforward indeed. So that's the cash account. Let's move on to a couple more of these to see if we can get this done. The last area, of course, is our ratios. So here we have it. The markup and margin. The gross profit of a company can be expressed as a percentage. This percentage can be calculated based on the sales figure or the cost of sales figure, of course. Gross profit markup is based on cost. So whenever you're doing markup, it's always based on cost. Whenever you're doing margin, it's always based on sales price, selling price. Whereas this one is based on cost, the first one. If you look at the following trading account, the sales revenue is 5,000. So the sales revenue, I just write that a bit more clearly, sales revenue is 5,000. The cost of sales, of course, is 4,000. The gross profit is 1,000. No problem so far. So this is an assumption and some assumed figures you've been given to help you to understand. So no problem with that. Sales revenue minus cost of sales always equals gross profit. So you might put that in brackets, always equals gross profit. No problem with that whatsoever. However, something else is happening here. There's a gross profit margin of 1,000 on 4,000 multiplied by 25%, and that, of course, gives a percentage of 25%. Is that true? So if you've got 1,000 divided by 4,000 times 100, of course, that answers 25%. Write that a bit more neatly. How about the margin? That's the markup, you see. The margin says the 1,000 is the profit, but this time it's based on selling price, And if you multiply by 100, of course, you have 20%. So this time it's 1,000 divided by 5,000 times 100, and that's 20%. Very, very straightforward indeed. Example 9, if I may interest you in a couple more of these little exercises. Margin is 25%, sales is 1,000. What is the gross profit and cost of sales? Now, quite interesting this one. If my sales is given as 1,000 and the gross profit is said to be, in fact, you've been given that, but the margin is said to be 75%, I suppose the way you work out your cost of sales is to take 100 percentage points divided by, or we'll take our 1,000, which is in terms of 100%. So I'll divide that by 100, multiply by 75. That, of course, is the 750. And, of course, another way of looking at it is 75% of sales 1,000 equals 750, and that is the cost. I think that's marginally better, that little technique. So if they say to you the margin is 25% and the sales is 1,000, the cost, of course, must be 75%. And what's 75% of sales of 1,000? It must be 750. Very, very straightforward indeed.